Asset allocation, asset reallocation, diversification. Yes, thank you, but what are those terms? What do they mean? And how do they work? In this video, we're gonna see exactly that, especially for diversification, because you will be surprised to know that there is a specific way for diversifying. It's not like you can buy 100 stocks and that's it. There is a proper way. And in this video, we're gonna talk about it. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing, or finance in general. And if you love the subject, please consider subscribing. We already talked 100 times how much important it is to diversify, but we never actually talked about what diversification is and how diversification works. And well, diversification is important, but we first, of course, need to understand why we want to diversify. Well, we want to diversify mainly to reduce risk. But what is risk? So let's understand what is risk, because this is the first thing that we need to understand. So if we want to reduce risk, of course, we need to understand what is risk and what do we mean by risk. Well, there are many ways to actually calculate risk and to actually quantify risk. One of these many ways, and the way that it's mainly most used, especially for people that don't know much about economics, is volatility. So the measurement of volatility will give you the risk of the specific instrument. Okay, and what is volatility? Volatility simply means the oscillations of the prices on the market. So by risk, we identify the possibility that in the future, the underlying asset is not gonna meet our expectations. And how does that underlying asset cannot meet our expectations? By fluctuating. Okay, so the more an instrument fluctuates, the more it's hard to predict its direction, the more it's gonna be risky. And volatility, it's a simple mathematical formula of the what? And volatility, it's simply a mathematical formula of the standard deviation. So again, exactly how much in percentage the prices move from their mean. And it's normally annualized. Okay, so let's put it as an example so we can understand it all. Okay, so if we see a volatility of 10% on a certain instrument, we can say that in 1 year, if that percentage is annualized, that underlying asset or that instrument is gonna make either a plus 10% or a minus 10%. That's of course not for sure, that's calculated historically. Okay, obviously volatility, it's not only connected to particular instruments or to particular underlying assets, it's also connected to portfolios. If you go to a financial advisor, he will probably, hopefully, give you the volatility of the portfolio that he suggested, and so he will give you the risk of that portfolio. Now, another thing that we need to understand is the specific risk. Specific risk is a type of risk that is connected particularly to a specific either company or sector or specific underlying asset. Everything has a specific risk, okay? So let's take, for example, Amazon. Amazon has some type of specific risks. These are the retail industry, for example. This is the US market. This can also be a Chinese market in some ways. Okay, many things come from China. So those are some specific risks of Amazon. Okay, now let's take, for example, JP Morgan. JP Morgan has a specific risk of banking, the banking sector. Okay, interest rates are specific risks. Other currencies are specific risks. The forex market is a specific risk. Okay, especially the US dollar against other currencies. Okay, bonds are a specific risk. Okay, and what does it happen if we take JP Morgan and then we take another bank? For example, I don't know, we take Bank of America. Okay, what happens when we put those two companies in the same portfolio? Are we gonna have different specific risks? No. Those two companies have very similar specific risks. Both are banks, both have the specific risk connected to the US market, both have the specific risk connected to bonds, and so on. But what happens if we now take JP Morgan and we take Amazon, for example? We put them in the same portfolio, and guess what? They do not have the same specific risks. So what does it happen to our portfolio? It's gonna lower its volatility. How does that happen? Let's see. Before seeing how to lower volatility of a portfolio in this way, and how the volatility is actually lowered, because I promise you, it sounds like magic, let's make another example. Okay, let's talk about ETFs. We know that ETFs are pretty diversified. Let's take one of the most diversified ETFs. Let's take the global ETF, the iShares World, for example, okay, or let's take the index, okay? Well, that ETF is broadly diversified. And what happens to our specific risks? It goes almost to zero, okay? That's simply because we have a mix of many specific risks. So that means that, for example, for a global ETF, what happens if the Italian economy goes down? Nothing, or at least not much, okay? And there are all the other economies that can draw up the ETF. Now, let's imagine an ETF on Europe, for example, okay? And let's imagine an ETF on Italy. What happens if I put those two ETFs in the same portfolio? Did I diversify? What happens if Italy goes down? Well, Europe's probably follows. And what happens if Europe goes down? Well, Italy, most likely, even more likely, follows. That means that these two instruments have very, very similar specific risks. But how do we calculate specific risks? We do that with the so-called correlation. So what is correlation? Correlation is simply a number. It goes from -1 to 1, passing through 0, where 1 is the maximum correlation, -1 is the maximum decorrelation, and 0 is a neutral correlation. How do we calculate correlation? Correlation is calculated through prices. We need to understand that specific risks reflect on the prices of the instruments. So if I have some specific risks in my company on the stock market is going to reflect those risks. Let's make an example. If we take Amazon and the retail market goes down, or the US market goes down, guess what? Amazon is also probably gonna go down to a certain extent. And that translates to the specific risks of the retail market or the US market going down and bringing down Amazon as well. That's because Amazon has that particular specific risk. Okay, so if we say that the specific risks are reflected on the prices of the underlying assets, then we can say that we can calculate correlation using prices. And that's exactly what we do. So we take two companies, or we take two markets, the European and the Italian, or the European and the US market. Okay, we take even two instruments. We take bonds, European bonds and US bonds, for example, okay, and we correlate them. We can also take European bonds, European stocks, we correlate them. We see how much those two prices, those two charts, normally based on indices, move alike. If they move a lot alike, so if one goes up 10% and the other one goes up 15%, for example, that's a good correlation, okay, that's near to one correlation. If one goes up 10%, the other one goes down 8% or 10% or 15%, then that's a correlation that it's near to -1. To give you, again, a practical number, the correlation between the Italian market, stock market, and the European stock market is 0.86. Of course, these correlations change with time, so they are not fixed, but of course they are very good approximations, okay? From this table, for example, you can see the correlation matrix and you can see different things, how correlated they are. But why do I care about correlations, and why do I even talk about it? Well, how do we lower volatility? We asked before, with decorrelation. So when we want to diversify a portfolio, we need to choose instruments or underlying assets that are highly decorrelated from each other. That's simply because in that way we are gonna lower volatility. But how does that happen? And here, let me explain you the magic. So let's take, for example, Amazon again. It goes up 10%, it goes down 5%, goes up 10%, goes down 5%, for example. At the end of the year, Amazon is up 20%, okay? Now, let's take another company, let's take JP Morgan, okay? Completely opposite company, doesn't have the specific risks of Amazon, or at least not all of them. So they are very decorrelated. That means that when Amazon went up 10%, JP Morgan maybe went down 5%. When Amazon went down 5%, JP Morgan went up 8%, for example, okay? So let's say at the end of the year, JP Morgan has a final result of plus 10%. What happened to my return? Well, my return went to 15%, okay? 10% plus 20% divided by 2, that's a normal average, 15%. What happens with my volatility? So let's say Amazon has a volatility of 10%, for example, or maybe more, let's say 30%, okay? And then JP Morgan has a volatility of 10%, let's say, okay? What happens to my volatility? Do I do 10 plus 30 divided by 2 and I get 20? No, of course not. Think about my portfolio composition and think about what my portfolio does. If Amazon goes up 10% and JP Morgan goes down 5%, I go up 5%. And what happens when Amazon goes down 5% and JP Morgan goes up 10%? I go up 3%. Okay? So you see that my movements are much lower than both Amazon and JP Morgan. That's simply because they are decorrelated. At the end of the day, I will have a volatility which is lower than the volatility of Amazon and the volatility of JP Morgan. If instead I took Bank of America and JP Morgan, they had similar movements, therefore a very high correlation, meaning if JP Morgan went up 10%, probably also Bank of America went up, maybe 12%, which means that I got a volatility of a combination of the two, just like before. But before, I did 10 plus negative 8, or whatever it was before, and now what I do is 10 plus 12, or whatever it was before. Okay, so having highly correlated underlying asset gives me an amplified volatility, whereas having highly decorrelated underlying assets gives me reduced volatility. And that's what we want. If volatility is a measure of risk, that's what we want. We want to reduce risk. And guess what happens to my return? It's just an average. Therefore, it doesn't change. Okay? So my average, my return, is the same, but my volatility, so my risk, is lower. Okay? And this is how you do it. Of course, you can do it with different weights. You can choose whether to put, 20% of your capital on JP Morgan and 80% on Amazon. Of course, you would not do it only with JP Morgan and Amazon. You do it maybe with ETFs, different sectors, different companies even, okay? But you also have to change the weights. But we cannot go much deeper into that because then we would have to talk about the efficiency frontier. But let me know in the comments if you want me to talk about the efficiency frontier and how to actually build a portfolio. Okay, and how portfolios are actually calculated to be as efficient as possible, because that's all about it. Okay, so we need portfolios that are efficient, and an efficient portfolio means the lowest risk possible for the highest amount of return that we can for that risk. So yes, that's all I had to say for diversification. As you can see, it's not an easy topic to talk about, it's not an easy topic to understand, I know that. If you have any doubts, please fill down the comments. And yes, thank you for watching. If you enjoyed the video, please leave it a like and let me know in the comments what you think about diversification, if you already knew about this stuff. And yes, I will see you in the next video. I believe that investing and knowing how to invest our money is something that everyone should know. It's like counting numbers, in my opinion. So everyone should have that a basic understanding of what investment means, what investing means, and how to